Hello and welcome to the Get Money Rich podcast, where we dive into the world of investing, breaking down complex topics to help you make informed financial decisions. I'm your host, Money, and I am the blogger behind GetMoneyRich.com. Today, we are exploring a crucial topic for any investor: the difference between the blue chip stocks and penny stocks. To help illustrate these concepts, we will be looking at the investment strategies of two renowned investors, Warren Buffett and Porinju Veliyath. Let's start with the basics. What, what exactly are blue chip stocks? These are shares of well established companies with a strong history of reliable performance, strong financials, and market leadership. Think of them as the stalwarts of the stock market. These are companies that have proven their worth over time. Blue chip stocks have a few defining characteristics. They usually have a large market capitalization, strong financial performance, and they often pay very good dividends. These are the parameters we can use to broadly filter blue chip stocks from other stocks. The blue chip stocks are market leaders in their industries and tend to be less volatile in terms of their stock price fluctuations. One prime example is Warren Buffett's investment in Coca-Cola. Warren Buffett is an investor who primarily invests only in blue chip stocks, and his investment in Coca-Cola is a prime example. This global beverage giant, Coca-Cola, has a robust financial history and a dominant market presence. Buffett's investment in Coca-Cola reflects Buffett's preference for stable companies that display long-term growth and and a company that pays uh, dividend payments historically in a reliable way. This is the essence of blue chip investing. Now, let's turn our attention to penny stocks. These are shares of small companies trading at low prices, typically under rupees 10, sometimes also under rupees 1. Generally, in my stock screener, I filter penny stocks as those stocks whose price is less than rupees 50, because there are not many quality stocks that you will find which are priced under rupees 1 or rupees 10. So, penny stocks are often associated with small cap or micro cap companies that are known for their high risk and potential for significant returns. So, this is a characteristic of penny stocks. On one side, they are very, very risky. If if their price falls, it can even fall by 30-50%. But if their price goes up, it can go 100% in a matter of few months. So this is the potential for penny stocks. There is a risk, but if we pick the right penny stock, if we have those skills of picking the right penny stock, we can make a lot of money by investing in this type of companies. Penny stocks have their own set of characteristics. They don't behave like normal other stocks. These penny stocks are how to filter these penny stocks from other stocks. First of all, they usually have a low market capitalization and a very high price volatility. So if you check the beta of a stock and if the stock beta is too high, you can finger that stock and tell that it is a penny stock maybe. And these stocks also have a very limited financial history. These are comparatively new companies who have either doing business for a short time, or they have been listed quite recently. Such stocks are often traded more by the speculators than the investors. That's why there is so much volatility in their market price. But a good penny stock can offer potential for high returns if things go in a right way. But if things are not going in the right direction, they can also lead to very high losses. So, a person who wants to invest in penny stock should know this thing, that if things are going well, it's okay. If things are not going well, uh, the investment can really go down the drain. Porinju Veliyath is an investor known for his contrarian style of investing. He's a contrarian investor. Basically, he's a value investor like Warren Buffett, but he wants to focus more on mid cap, small cap, and penny stocks. He is not an investor who is known to practice value investing by investing in blue chip companies. He mostly will focus on mid cap, small cap, and if the quality of the company allows, he can also invest in penny stocks. But the prime thing for Porinju Veliyath is he will only consider investing in penny stocks if it is displaying a very strong business fundamentals. The fundamentals of the business should be very strong. Otherwise, he will not dare touch any penny stock or small cap stock. Porinju Veliath's approach involves identifying companies overlooked by the market but with strong growth potential. So, what does it mean? It means that he looks very intently for all the companies that are listed in the stock market. Out of all the companies that are listed, there will be some companies which are out of favor, means not many investors have uh, are focusing on that company. It means there not many people are investing in that stock. So first of all, he will check such companies, and then he will open their balance sheet, profit and loss accounts, cash flow statements of maybe last 10 years, and then he will check that how is the fundamental of this company. If the fundamental is uh, strong, if the fundamentals of the company is strong, and for some reason the investors, the other investors, the big investors, the mutual fund companies, FIIs are not focusing on such a stock, then it is a buy opportunity for Porinju Veliath. Veliath's investment in these small companies which are out of favor are often yield significant returns despite the higher associated risks. So, how do these type of stocks compare in terms of risk and reward? I'm talking about blue chip versus penny stocks. Blue chip stocks are associated with low risk and stable returns. They are suitable for investors prioritizing capital preservation and steady income. How come? Because they are stocks of very big and reliable companies, so volatility is less and steady income in terms of the dividend that they pay to their shareholders. Warren Buffett's strategy epitomizes this style of investing, blue chip style of investing. His portfolio is filled with blue chip stocks that offer reliable dividends and long term capital appreciation. So, but the difference is the price at which Warren Buffett buy these blue chip companies. He do not go around fishing for these companies at all times. When the stock market has crashed, at that time he goes in and buy these blue chip companies at a very discounted price. This is the style of Warren Buffett investing. He will buy blue chip stocks, but when there is a market crash, when the stock is completely out of favor. By focusing on companies with strong economic moat and consistent performance, Buffett ensures a stable return on investment, minimizing minimizing the risk. This is Buffett's style of investing. On the other hand, penny stocks are high risk investments with the potential for high rewards. On one side, there is a risk, but they can also be very rewarding if the things go in as you are thinking. These stocks can experience significant price swings, leading to substantial gains or losses. Porinju Veliyath's approach of investing in undervalued small cap, mid cap, or penny stocks often result in impressive returns. Here I will underline that Porinju Veliyath does not simply go on and buy stocks of all kind of stocks from mid cap and small cap space. He will go buy only those stocks which are undervalued, and this style of investing showcase the high reward nature of penny stocks. How can a penny stock give such high returns? They will give such high returns only when, number one, their fundamentals are strong, it has a strong business, and number two, when they are bought at a discounted price. Suppose you are buying a penny stock at the when the stock market has bottomed during the COVID crisis. Buying stocks at the bottom, a penny stock at the bottom of the market, and then maybe holding it for another 2 years. Do you know what kind of returns it would have given you? Maybe it would have uh, tripled, or maybe 5 times would have become your investment if you have bought a penny stock at those levels, and maybe you would have continued to hold it for another 2 3 years. So this is the potential from a penny stock. Investment strategies for blue chip and penny stocks also differ markedly. So a strategy that you will use to invest in blue chip stocks may not be in the same strategy cannot be used for penny stock type of investing. Blue chip investors typically adopt a long term perspective, focusing on the intrinsic value of the company and its ability to generate steady returns over time. Warren Buffett's long term value investing strategy involves buying and holding shares of fundamentally strong companies. His patience and discipline in holding these stocks over the long term allow him to benefit from the compounding growth. This is very important. It is not only important to buy a blue chip stock at an undervalued price, it is also important to hold those stocks patiently for a very, very long time. It is said that Warren Buffett bought his Coca-Cola stocks way back in 1988. He still hold most of his Coca-Cola stocks. So this is the kind of holding period, this is the kind of patience a person should show when he is investing in a blue chip stock. Buy a blue chip stock at an undervalued price and then hold it for like forever. And this is what kicks the power of compounding. In contrast, penny stock investors can employ a more short term, opportunistic approach. These type of investors seek undervalued or overlooked stocks with the potential for rapid price appreciation. So what does it mean? It means that first of all, you locate a penny stock, A stock which has been overlooked by the market. It has a good fundamentals, but completely overlooked just because it is a penny stock. So there will be not many investors in that. So locate such a stock, buy them, and then wait for a short period. Like Coca-Cola, you are buying to hold it for next 20 years. But penny stock, buy it with an intention of holding it for, let's say, 2 years. Once the market also realize that there is a penny stock which has strong fundamentals and not there are not many investors in that, so people will start buying, and at that time the price of that penny stock will start surging. It will go up, it will start multiplying, and this is the time, maybe in next 2 3 years, that you will see that your stock has already maybe become 10x. At that time, sell that penny stock. So the money that you have, that you will redeem by selling a penny stock, use it to buy a blue chip stock. So this is the way I try to practice stock investing. Buy a penny stock, hold it for some time, make X amount of a multiple in that, and then redeem and use that money to buy a blue chip stock. So this is why in this podcast I have taken this topic of blue chip versus penny. How how we can blend these two style of investing to to create a big portfolio. Porinju Veliyath's focus on small and mid-cap stocks requires a keen eye for undervalued opportunities and a willingness to take calculated risks, aiming for significant capital gains in the short term. So Porinju Veliyath is investing in mid and small cap stocks. But see, his focus is not only on the name of the stock or on the price of the stock. His focus is how much undervalued is this stock? How is the fundamental of this stock? So, okay, he's investing in small cap stocks, in a penny stock, but his focus is like Warren Buffett. Whether the stock is undervalued, he's asking these questions: whether the stock is undervalued, whether the business is strong or not, whether uh, the stock already has too much investor, or it is an overlooked stock. So broadly speaking, the theories of investing in a penny or a blue chip stock are same, but here the focus is but here the difference is, blue chip stocks can be bought and held for a very very long term, like forever. And but penny stocks, it's better to buy them, make quick bucks, and then get out maybe after 2 3 years. The market perception and volatility are crucial factors differentiating blue chip stocks from penny stocks. Blue chip stocks are generally perceived as safe, stable investments with predictable performance. They tend to have lower volatility and more predictable price movements. So people who who are investing in the market and who do not want to take so much risks, they must invest in a blue chip stock. They should not go for small cap penny stocks. So if you're an investor whose psychology needs growth, of course, but the price should also be stable. If that is the priority, then blue chip stock is for you. Buffett's investment in companies like Apple and Johnson are characterized by their stability. These companies are widely respected in the market, contributing to the lower volatility and their stock price. If suppose Warren Buffett would have been in India, where he would have been investing? In India, Apple and Johnson equivalent companies are like TCS, Nestle India, Britannia Industries, maybe other FMCG stocks or oil and gas companies, some utility companies from the government side, banks. So these are the companies that Warren Buffett would consider if he would be investing in India. Penny stocks, on the other hand, are often viewed with skepticism due to their high volatility and lack of consistent performance. Their prices can be highly unpredictable, influenced by market sentiments, news, and speculative trading. So, penny stocks, though their fundamentals can be very strong, but their prices fluctuate a lot because speculators invest in them. And this is why whenever, even if Porinju Veliyath is investing in a penny stock, he will invest in them with lot of skepticism, lot of caution. He will think more of what can go wrong than what will go right. So he will protect himself from the potential downfalls. And that's why his focus on the price at which he's buying a stock, his focus on the business fundamentals of the stock is 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 become a prime criteria for buying a penny stock. Porinju's portfolio, with its focus on small and mid-cap stocks, experience high volatility. While this volatility presents opportunities for high returns, it also introduces significant risk, requires careful and strategic approach to investing. So Porinju's portfolio, no doubt he's how careful he is in picking stocks, but because his focus is mostly in mid cap and small cap space, volatility of his portfolio will be much higher as compared to Warren Buffett type of portfolio. So in conclusion, understanding the difference between blue chip stocks and penny stocks is crucial for any investor. Blue chip stocks offer stability, lower risk, and steady returns, making them ideal for conservative long-term investor like Warren Buffett. Penny stocks, with their high risk and potential for substantial rewards, appeal to those who are willing to take calculated risks. Very important, calculated risks, as exemplified by the Porinju Veliyath's investment strategy. Invest in penny stocks, no problem in that, but you must be ready to take calculated risk. And when you say calculated risk, here there are two variables to consider: the price at which you are buying, and if the company's fundamentals are good or not. Do not buy a junk stock thinking that this is, because it is a penny stock, its price will go up. No, it will not go up. If its business does not support its price, it will crash further. Ultimately, the choice between a blue chip and a penny stock depends on your risk tolerance, investment goals, and market outlook. By learning from the approaches of successful investors like Warren Buffett and Porinju Veliyath, we can make more informed decisions and tailor our investment strategies to suit our individual needs. Thanks for tuning into Get Money Rich podcast. If you have found this episode helpful, please consider subscribing to my YouTube channel and leaving a comment in the comment section below. Join us next time as we continue to explore the world of investing. Until then, happy investing.